Welcome to The Explainer. I'm so thrilled you're here with us today. Look, we're going to dive right into a topic that's, well, absolutely crucial for our financial futures. But let's be honest, it's also one that feels incredibly intimidating for a lot of people. We're talking about the stock market. More specifically, we're looking at how you can actually overcome its extreme complexities by harnessing the power of mutual funds. So let's start with a bit of a reality check, right? We all know investing is a massive part of any solid financial plan. I mean, it's how you grow your wealth, beat inflation, and actually hit those big financial goals in life. But here's the giant roadblock we all hit. Picking individual stocks, it honestly feels like a full-time job. Between managing your career, family, and, just trying to have a life, who actually has the time to rigorously research the stock market every single day? Seriously, if the market just feels totally overwhelming to you, you are completely normal. Our source material from HDFC actually hits the nail right on the head. They state, retail investors lack the knowledge and even the time to research and educate themselves about the nitty-gritties of stock market movements. And it's so true. The modern investor is just incredibly busy. Recognizing that limitation, that's not a weakness at all. It's actually the very first step to building a much smarter financial strategy. So, that brings us to Section 1, the stock market dilemma. When you're investing directly in equities, you can't just, pick a company because you like their logo or their products. You have to analyze industry and sector trends, evaluate the size and structure of the company, and dig deep into the management's track record, which is basically like running a corporate background check. And then you have to juxtapose all of that against macroeconomic conditions using both fundamental and technical analysis. I mean, wow, that is a staggering amount of specialized knowledge required just to make one safe investment. Which perfectly sets up Section 2. Enter the mutual fund. Let's break down exactly what a mutual fund is. Think of it as the ultimate teamwork. It's essentially a large pool of savings gathered from numerous investors who all share a common financial goal. So instead of you trying to figure it all out on your own, your money is combined with everyone else's and handed over to a market expert, a professional fund manager. That manager then invests this massive pool across various securities, things like stocks and bonds. The actual day-to-day operation is incredibly simple for you. Step 1, investors pool their money together. Step 2, that professional fund manager steps in. They're the ones doing all the heavy lifting we just talked about, analyzing the market, checking out management track records, the whole shebang. And then step 3, they allocate that money into the right mix of stocks, bonds, or commodities based on the fund's goals. Basically, you provide the capital and they provide the expertise. And this brings us to a really crucial realization. When you invest in a mutual fund, you aren't just buying a random basket of stocks. You're literally paying for decades of professional experience. These fund managers are backed by dedicated, well-formed research teams that analyze the markets every single day. So you're effectively outsourcing the stress of the stock market to the pros, which, let's be honest, gives you absolute peace of mind. All right, moving on to Section 3, mutual funds versus direct equity. Now, when we put these two side by side, a pretty fascinating irony emerges. Giving up control can actually be your biggest advantage. Look, with direct stocks, you have complete control over individual stock selection, and sure, you can speculate all you want. With mutual funds, you have absolutely no control over that. But remember our dilemma from earlier? You probably don't have the time or expertise to make those picks safely anyway. By giving up that speculation to a pro, you protect yourself from those really costly rookie mistakes. Do keep in mind, though, that mutual funds can sometimes come with an exit load, which is just a fee if you decide to pull your money out early. But here's the best part. While you're giving up the day-to-day stress, you keep all the massive benefits of the market. You still get great sectoral exposure, high liquidity, and the ability to do systematic investment planning, or SIPs. But here is the massive bonus. Certain mutual funds, specifically equity-linked savings schemes, actually offer tax deductions under Section 80C. So you're getting the growth of the market, it's managed by a pro, and you're actively lowering your tax bill. Talk about a win-win. Let's jump right into Section 4, tailoring to your risk. So beyond just peace of mind, mutual funds actually offer incredible customization. If you're young or maybe you just have a really high risk appetite and want aggressive growth, you can go for equity mutual funds. These invest a large portion of your money straight into stocks. But if you have a lower risk appetite, say you're getting closer to retirement or you just absolutely hate market volatility, you can choose debt mutual funds. Those invest your money into much safer instruments like government and corporate bonds. You dictate the risk level, and the manager simply executes the strategy.
It's also vital to remember that these aren't just abstract financial vehicles. As our sources from Shriram Finance point out, mutual funds are highly practical tools designed to help you hit your major life milestones. Whether your specific goal is long-term wealth creation, planning for your retirement, funding your child's education, saving for a home or car, or just tax savings, there is quite literally a specific mutual fund structured to help you get exactly there.
And that brings us to Section 5, the wrap-up.
So let's look at why mutual funds really win for retail investors. Here's the core value proposition. They completely remove the massive barriers of time and market knowledge that keep everyday folks out of the stock market. They offer instant portfolio diversification, meaning your risk is safely spread out. They allow for small, systematic investments over time, and this is huge, they are fully regulated for safety by SEBI, the Securities and Exchange Board of India. They truly democratize wealth generation.
Which leaves us with a final, incredibly important question to ask yourself today. If you know that you need to invest, but you honestly just don't have the time to become a stock market expert, isn't it time you hired one through a mutual fund? Stop letting the complexity of the market hold your wealth back. Pool your resources, trust the professionals, and let your money finally start working for you. Thanks for joining me on this explainer, and happy investing.